Given what happened to the price of gold on Wednesday, as we've been putting together this special package on the weekend edition of Financial Sense, I thought, well, we've been talking about gold. We're talking about silver. Let's get somebody to talk about the gold stocks. And I couldn't think of anyone better to have on the program but John Doody, gold stock analyst, editor of the Gold Stock Analyst. And John joins us on the program now. John, good to have you back on the program.
Hey, Jim. How are you?
Hey, pretty good. We got that big knockdown on gold on Wednesday, and people are freaking out. And once again, some of the stocks are underperforming. At least the major indexes are underperforming the bullion. They're up, but they're underperforming. I don't know if you read, John, the Ray Dalio piece where he was trying to analyze gold. And he said, well, you can't analyze it on PE ratios. And what he did is he took money supply, and there's a 90% correlation between money supply and the price of gold.
Yeah, money supply expands, the gold price goes up.
Yeah. So what he was saying, John, is that given where the money supply is, and it's not just here, it's globally, he took the largest economies. Yeah. He said gold is undervalued by 20%. It should be in the neighborhood of 2,100 to 2,200. Therefore, if Dalio is saying gold today is undervalued by 20%, I'm looking at your Amex Gold Index where you rate it in terms of cheap or expensive, and you're showing in your recent newsletter it is undervalued by 17%. Well, if the stocks are...
The stocks are undervalued at the current price of gold.
Yeah. So if gold is undervalued by 20% and stocks are undervalued, it tells me that one of the best buys in the metals market are the stocks right now, and yet nobody seems to be paying attention to that fact.
Yeah, well, you don't have any, the popular media don't have any reason to talk about gold because in a favorable light, because if gold was the place to be, you wouldn't need CNBC. And if the gold stocks were, there's only, 50 to talk about of any size, then if that's all you talk about, you could do that an hour or two every day and you just run movies the rest of the time. Maria Bartiromo is protecting her job by poo-pooing gold. Trying to, anyway.
It's amazing because I'm looking at a recent issue of Gold Stock Analyst, and not only are many of these companies minting money, despite even some of the setbacks and write-downs, for example, Agnico Eagle, cash flow-wise, they managed to produce $1 billion. I mean, a lot of these companies I can think of very few industries, John, right now, where the price on the day you and I are speaking, gold is at $1,720, and the cash cost of gold is a little over $1,600. These guys are printing almost $1,000 profit for every ounce they produce.
Yeah, the cash cost to make an ounce, is about $600, a little under.
Yeah.
Yeah. So $571 is what we're carrying for an average cash cost per ounce of gold in 2012, based upon what the companies are forecasting. $571 the cash cost per ounce to produce an ounce of gold.
Yeah, you're making $1,100. Even the silver companies at $35 an ounce, even the silver companies are minting money.
Sure.
One thing that you and I have talked about in the past that, one way that a lot of these companies were going to start competing with the ETF was to start paying dividends. I wonder if we can just spend a few moments because that's what we're starting to see. I don't care if you're talking about Silver Wheaton, which is tying its cash flow, 20% of it, to dividends. They've tripled their dividend. Agnico Eagle is raising theirs, Barrick, Newmont, everywhere you look, you're finding dividend yields that are competitive with what I call 10-year treasuries.
Sure, and you've got a real upside on that, and there's no upside on treasuries. It's a downside. When interest rates rise, the treasuries are going to get killed, particularly the longer ones.
When you look at this market right now, and I know like GSA Pro, you have a lot of analysts, are you seeing more acceptance? Because when I look at mutual fund portfolios, at least the large mutual funds in this country, John, you do not see a lot of gold stocks in the portfolio. Yeah, you might find a Gold Corp. Occasionally you find a Barrick or a Newmont, but certainly you don't find the institutional level holdings of these stocks in the same way that, let's say, if I would have looked at a mutual fund in 1999, it was not unusual to see 15-20% in technology stocks.
Well, I think the funds have got a totally different attitude than most, and most investors don't recognize it, that that funds make their money not on the gains that they get, not on their outperformance. They just want to meet the benchmarks. If the fund can do the same, as the S&P 500 or whatever their benchmark is, they're very happy, and they get their money on the what they charge on their asset base, and that 1% of $50 billion in the fund or whatever is a big number. So these guys aren't looking to outperform, and they all want to have a gold stock or two in the fund so that the guy selling the fund to the retail investor can say, oh, yeah, they got gold, they got Newmont, that company, or they got Barrick or whatever. But there's no interest in the part of most funds to try to get one area of the market that's going to do better than the rest. They just want to be equalized across the board. When you go to gold funds, you get the same attitude. And if I'm going to be a fund investor, I want to know who the manager of that fund is. And we have some fund managers, big guys that are big funds that are subscribers, but they don't really they never do as well as the GSA top 10 because they're basically just trying to minimize risk and meet the indexes. And if I was people ask me all the time, who would I recommend for a fund? I want to own a fund. And it's always make sure you know who the fund manager is. In that case, it's the guy I often recommend is either John Hathaway at Tocqueville or Frank Holmes at U.S. Global. Those guys understand gold and they're interested in it, but they're the anomalies in the gold in the fund market, not the ordinary guys.
Yeah, because I'm just looking at, I have a Bloomberg screen, and this is just phenomenal. Last March, around this very same time, Newmont was paying 15 cents a share quarterly in dividends. They just announced their next dividend, which will be for shareholders as of April. They just raised it to 42.5 cents, John. That is almost a threefold increase in the dividend in a 12-month period. This likewise, you could go to Silver Wheaton that was paying 3 cents. They're now paying 9 cents. If I go to Yamana started last year paying 3 cents a share dividend quarterly. They're now upped it, and it's going to be 6 cents.
Yep. No, I agree. And I don't know how long it's going to take for people to realize this, but you're absolutely right. Compared to a treasury, you can get a higher yield and you get some price appreciation. And there's no appreciation in treasuries. So but it takes a while for people to wake up to this, I guess. And the interesting thing is, from our own personal standpoint, is our subscriber base continues to grow. So there is obviously developing interest, but it's just slow. And it's not, we don't see any huge money coming into the market.
You know what surprises me, and this is very characteristic of the bull market in stocks, John, because I got in this industry at the end of the last bull market in around 1979, where there was no price too high that you would pay to own bullion or gold stocks. Of course, we have a lot more vehicles to invest in today with the ETFs. But if you take a look at the small percentage that has gone into this sector, if I was to tell you right now that in the next 12 years, there's a new sector you're going to want to be invested in, and that sector is going to be going up double digits a year, you would think I would get your attention. But that's exactly what we've seen on the day you and I are speaking, despite the big sell-off on Wednesday. Gold prices are up 10%. Silver prices are up 27%. This is the 12th consecutive year that gold prices have gone up, and yet it reminds me of the bull market in stocks in the 80s and 90s. The bulk of the public came into the stock market in 1995 when the bull market was 13 years into that market, but the bulk of the money came in from 1995 to 2000. I wonder if we're going to see the same thing in the gold market.
Well, maybe that'll be a sign of the top. But, I'll tell you something interesting. Yesterday was a pretty big drop in the price of gold. It was down $84 to a $16.96 close in New York after it closed on the COMEX. And, in the past, see people panicking with calls and emails, what's going on, should I get out, blah, blah, blah. And we have a 5-digit subscriber base. We didn't get a single call or email, which I think represents a growing up on the part of the typical gold investor now. The typical investor recognizes that, how was that song? Mama said there'd be days like this. And there are days like this occasionally because you have two participants in the gold market. You have long-term investors like, your clients, my subscribers. These guys are long-term, and they know that the market's going to be up and down. And then you got laid on top of that a short-term investor that's the hedge fund that margins and goes for maximum returns. And these guys all sold yesterday. I mean, there were 44 million shares of GLD traded yesterday, 4.5 million ounces it represents, and it would be more on the COMEX and more on the other ETFs. These guys sold because Bernanke didn't come right out and say there's going to be QE3. And so they were all piled into gold, I guess, on the expectation that Bernanke was going to give some kind of a signal. And they totally ignored the fact that Europe did its own version of QE2, and they're writing $700 billion of loans to banks at 1%, so the banks can unload their crappy holdings on top of the ECB. And, I mean, that's all inflationary, and yet they totally ignored that. So, but as I said, not a single subscriber called or emailed or said anything, anything at all. So I think, and I don't know what your client base was like, but I took that as a really a signal we've got a bunch of grown-ups in this market, and they understand that the long-term trend continues up. Every monetary phenomenon is something that can support higher gold, and it's just a question of when. And maybe we're just going to have to keep grinding it out like we have for the last 10 years.
You know what I've seen in this bull market since it began in 2001, John? We get these upsurge. I mean, if you take a look at the HUI, it hit a low of 40 on January 5th in 2001, and then we got a big surge where it got up into the 150 area, and then it sort of consolidated there for about a year, and then it took off again, and then we got up to the level of about 250, consolidated again for a little over a year period, took off again. And if I look at this in a chart, and for our listeners who are listening to this broadcast, just pull up a chart of the HUI, and you could see it, John. It's almost like a stair-step approach. It goes up, hits a new record level, consolidates and flattens out for a little bit, then takes off, hits another level, consolidates, and we've had, 1, 2, 3, 4, 5 of these with the recent one beginning last year. But when I look at the price of bullion, which has gone up sixfold, people would say, boy, that's a heck of a return. John, when I look at the HUI going from 40 all the way up to 640 last year, and then take a look at where it is today, you've had almost a 10 and 11-fold, so it still points out that over the long run, you're going to make more money in the stocks. Yep.
That's how you get the leverage. Not only do the companies make more profits, but the ounces that they've got in the ground, their reserves, they're worth more money. And those are the ounces they'll mine in the future at higher prices.
Now, something else that you and I have discussed, and boy, it just seems to me like there's an opportunity here. We know that these mining companies at $571 cash cost and gold at $1,700 are making a fortune per ounce of gold that they mine or per ounce of silver. Looking in your stock data, and you evaluate these companies on market cap per ounce and plus market cap per production, a lot of these high flyers, they used to sell for $700, $800, $900 market cap per ounce in the ground. A lot of these high flyers have fallen down to what I consider to be bargain levels. And I'm looking at, for example, Agnico Eagle, which is down to a market cap of about $322 an ounce, John. I can remember when they were selling at $800 and $900 an ounce.
Sure. That's when the stock was $80.
Yeah, wouldn't it be accretive for some of these guys and even some of the guys that have more expensive ounces that are having, let's say, $700, $800 an ounce in the ground, to go out and buy somebody that is selling for a couple $100 an ounce in the ground? It seems to me you would create shareholder value by doing that.
Yeah, well, that's the typical, in the broad market, that's the high PE stock buying the low PE stock and then re-rating the low PE earnings at the higher PE of the buyer. And sure, you can make a case for that. I mean, you can look at Yamana, which has still got a high valued ounces at almost $800 an ounce. They could certainly buy an Agnico Eagle, and it wouldn't really change much of their profile. Both Agnico and Yamana are interested in North and South America. Agnico's got one Sweden mine or Finland mine. But they're not in high-risk political risk areas, and they're generally in mining-friendly areas. And, you could make a good case for that, but the question is, who's going to end up running it, Peter Maroney or Sean Boyd? I mean, they're both younger guys. They're both under 50, and I don't think either one of them wants to retire. So that's the problem in mining, is that you got to find somebody who wants to give up the ghost and just had enough.